Continuing with the assumptions, we will also consider short selling, unlimited short selling is allowed, because solving the problem would also mean that if you have particular stocks for which is giving me negative returns, which is Ri minus Rf by sigma or Ri minus Rf by beta, if it is negative, so obviously it will mean that I can short sell that and utilize that amount, extra amount of money which I have in trying to buy particular other stocks which gives me positive returns. We will have unlimited riskless lending borrowing being there, which means I can go to the bank, I can borrow any amount of money, I can go to the bank and basically deposit any amount of money. Another thing which is important to note is that the riskless lending and borrowing values are same, but technically it is not true. In the sense, if I go to the bank and deposit or basically buy some dollars, or go to the bank and basically borrow some dollars, so obviously the rate at which I am buying and selling dollars is totally different, which means in the same case if I go to the bank and get a loan, or go to the bank and basically open a fixed deposit or a recurring one, the interest rates are different. But in our case we will consider both the interest rates are same. That means R suffix f for the lending case and R suffix f for the borrowing case, both the values are same. Investors define relevant periods in exactly the same manner. So if I am trying to basically analyze a problem for 1 month period, so the same or the different person, if he or she is trying to basically analyze a problem, then as mentioned the input information which is available related to the price is same for both of us, and obviously we will be analyzing our problem for the same time period. Obviously it may mean that I want to hold a particular portfolio for a longer duration, but when I break up into time frames, the time frames would exactly match such that any mismatch in the prices would not be reflected. So the ninth one would be investors have identical expectation with respect to necessary inputs from the portfolio. So obviously it may mean that my overall utility may be different, but the actual input based on which I am trying to find my utility and the expected value would be the same. So if I know that if the prices are increasing, or if there is an increase in the demand or increase in the supply, or vice versa, whatever it is, the exact information of the price is immediately available to all of us, all of the players who are there in the market, such that depending on a utility and depending on non-satiation, depending on the risk aversion property which any human being would have, he or she is able to analyze and get the best so called prices or best so called portfolio which would basically reflect the overall characteristics of the market with respect to the overall characteristics which a particular human being as an investor has. We will also consider the investors basically make the decision of buying a particular, selling a particular stock based on only two criteria. According to Markovich, the first moment which is expected value and the second moment which is basically the variance are the two criteria only based on which any human being will make a decision to buy or sell a particular stock. And the last one would be basically all assets are marketable, in the sense if there are particular assets which I want to sell, I have the full liberty to sell it in the market so that I can basically optimize my portfolio accordingly. And on the other hand, if I am trying to basically short sell a particular asset and try to buy another asset, that means I am trying to short sell Reliance and trying to buy Tata Motors, then Tata Motors is available for me in order to basically make my portfolio accordingly. Now for the one fund theorem, if you remember what it was, this is the efficient frontier considering n number of risk assets are there, this is the risk free interest rate. And if you remember, this risk free interest rate has only one value, not on depending on borrowing and lending. So if I draw the tangent, this is the value of Q. So this value of Q is basically the concept of one fund theorem, such that if I have this particular risk free interest rate and the Q portfolio which has inside it n number of such risky assets in different proportions, then combining them, that means the n such risky assets plus the nth one risk free interest rate, I can basically formulate my portfolio accordingly and basically be at a certain level of risk return framework which basically meets my demand accordingly. So this is the fund in the market index, it is a fund that contains shares of every stock in the market. So what technically we are trying to imply is that Q value is a certain portfolio which is conglomeration of all the assets in the market which mimics the market to the maximum possible extent, or which is the market. So the no question would be, what is that? Obviously it is the market index which is the BSE or the NSE in such a way that whatever price movements is happening for the BSE and the NSE, it basically replicates the market and gives us all the information on the market at one go, depending on the demand and supply of each and every stocks which is there. So obviously BSE or NSE does not have all the stocks in it, but price movement of those BSE 30 or NSE 50 is such, in a way that whatever price movement is happening for other stocks is immediately being reflected in the BSE and NSE prices. So, the price and demand and supply of the BSE and NSE gives out the exact picture of how the market is doing. So, now what our second question would be that how do we find out the weights. So, if you remember using the concept of the optimization, we found out the WIs, whether short selling is there or not there, such that it gives us a good picture about how the portfolio should be formulated. So, our main question is that how do we find out the weights. So, the weights of an asset in the marketed portfolio is the proportion of that asset's total capital value. So, now if I want to pause here for 1 minute. So, if you remember that I mentioned that if I have 100 rupees in my pocket, so total amount I am investing in stock 1, if it is 10 rupees, so it will be 10 by 100, this is the proportions. If I am investing 20 rupees in the second stock, the overall ratio would be 20 by 100. So, obviously W1 would be 0.1, W2 would be 0.2 and so on and so forth. Now, if it is basically stock, what is more important to note is that how do you find out the ratios. So, consider that say for example, you have stocks S1 to say for example SK, K is the number, and the corresponding number of such assets you are going to buy for the first stock is N1 till Nk. So, now the question would be what is the total capital worth, net worth of my total investment if I have invested N1 number of stocks in the first one, N2 in the second one till Nk in the kth one corresponding to the price which is S1, S2 till Sk. So, actually the weights which I find out would be very simply given by this. So, Ni divided into Si is the total amount which I am investing for the asset divided by the summation of Ni into Si, which means I multiply each and every stock number I have bought in that particular stock multiplied by the price of the stock is the total amount of investment which I have, and that goes in the denominator. In the numerator is basically the proportions of that particular asset which I am going to invest in that particular stock. So, coming back to the continuation of what the slide says, it says is equal to the proportion of the asset's total capital value to the total market value. The weight is called the market capitalization weights and is denoted by Wi, which we have been discussing. So, as we have already seen in the portfolio optimization problem using the Markowitz model. Now, the capital market pricing line is very important for us to find out how optimum or suboptimal the pricing of a particular stock is. So, it means the capital market or the pricing line shows the relationship between the expected rate of return and the risk. So, obviously, you have the risk return framework, that is true, but we want to find out that risk return framework or the risk of the particular stock with its return is how good or bad with respect to the market. So, obviously, you cannot beat the market. What you can do is that you can basically formulate your portfolio in such a way that the overall weights in that particular portfolio is such that it mimics the market to the maximum possible extent, and the movement of the particular price of the portfolio which you have formulated moves in tandem with the market. Obviously, the market will increase and decrease. So, what you want to do is that you want to invest in such a proportions in all the assets which is there in your portfolio, such that the price movements exactly goes as a hand in hand with the market. So, obviously, if it means that the market is increasing, your portfolio value which you have would also increase. If the market is decreasing, it would mean that the portfolio value which you have would also decrease, but the decrease and increase should be to the maximum possible extent, which means that the correlation coefficient existing between the so called portfolio which you have formulated and the market which is there, which you are trying to mimic is +1. So, obviously, it means that any 1 unit increase in the market would have 1 unit increase in a portfolio, or 1 unit decrease in the market value would have 1 unit decrease in the portfolio which you have. And risk increases so does the expected value, which is true. That means more I want, obviously there would be more risk, or if there is more risk, obviously I will invest in a particular portfolio which has more returns. Mathematically, we are trying to find out that what is the so called market line equation which mimics the risk and return of that particular portfolio which you are forming or the particular asset which you have. Now, if you basically see this equation, they are similar to the one of the singleton model. In the singleton model, what you have is Ri is equal to alpha I plus beta I Rm plus epsilon, and if you take the expected value, obviously epsilon vanishes because expected value of epsilon is 0. And in the similar way, what you have is the average return of the portfolio which is efficient, or a particular stock which is efficient is equal to Ri. So, consider Rf is in some way akin or a proxy of alpha I, because if you remember the y axis where it cuts, it means that it does not have any risk, but it is a return. And then if you go to the portfolio analysis which you have done and try to find out the tangential portfolio, this value which is equal to alpha is also equal to the Rf, which means Rf and alpha which you are talking about are generally the same. And we will consider that single index model when converted to the CAPM model and basically try to basically find a similarity between the capital market and the pricing line is exactly the same, where the equation is given in such a way that the return of the portfolio which you have or the return of the asset which you have which is efficient would be given by two terms. One is the risk free interest rate, or if you take it to the left hand side it will give you the excess return. So, the excess return of the portfolio and the asset would be equal to the excess return of the market multiplied by the ratios of the market, ratio being ratio of the risk of the market and the risk of the portfolio. So, what you have, this is the risk of the portfolio which you are forming, this is the risk of the market which you have, this risk means standard deviation. So, the ratios of this is exactly equal to the excess return which you have for that particular stock or the portfolio divided by the excess return of the market. So, obviously, if Rp is Rm, then the ratio is Rm minus Rp divided by Rm minus Rf, sorry, Rp minus Rf divided by Rm minus Rf would be 1. On the right hand side also sigma p will be equal to sigma n, hence the ratio also comes out to be 1. The slope of the capital market line is basically price of the risk. So, if you remember in the single index model we consider tan theta which was beta. So, basically this is akin to the concept of the price of the risk which you have to formulate in your problem in order to find out the best price of the particular stock and whether it is according to the capital assets pricing line. So, now if you basically plot the capital assets pricing line and recollect, so this is basically exactly the straight line. So, here you have the market, here you have the Calio Q, here you have basically alpha i's, here is basically you have the RF. So, again this is in a similar way to the exactly the single index model which you have already formulated. So, what we need to find out is what is the tan of that angle which is this, or tan of angle which is this, and try to find out what is the price of the risk based on which you are trying to formulate your so called portfolio of the asset. The capital market pricing line relates the expected value of the return of the efficient portfolio to its standard deviation. Remember, it does not show how the expected value rate of the return of an individual asset is related to the corresponding risk. So, what we are trying to do is that trying to find out the so called efficient portfolio with respect to its standard deviation of the risk, and efficient portfolio would be compared with the market, because we consider the market to be most efficient. If the market portfolio M is efficient, considered is efficient, then the expected value of any efficient portfolio, as we already discussed, would be exactly the same. So, if you come back to this formula, so what you have is the excess return. Now, in this term, it is basically standard, the ratio which is basically the standard the covariances existing between the so called portfolio and the market, divided by the covariance of the market with itself, which is the risk. So, if you find out the ratios and if this is 1, it means that the covariance of the portfolio with respect to the market divided by the covariance of the market with itself would be 1, which means that if we expand the term, the covariance term basically has 3 terms. One is the correlation coefficient, one is the standard deviation of the market, one is the standard deviation of the portfolio. So, if the correlation coefficient is 1 and the market and the portfolios are exactly the same, then this ratio which you have in front of you would be 1, which means the excess return which the market has is exactly equal to the excess return which the portfolio has. So, any positive negative movement on the market would be immediately mimicked in the same proportions in the portfolio. Another formula would be exactly the same. Here what you have is the excess return of the portfolio or any particular asset is equal to, if you remember and go back to this formula initially, you had basically beta into basically Rm. So, exactly the same. This is basically the tangent and this is the excess return of the particular market with respect to the portfolio. So, if you have a particular straight line, so this is the excess return which you have, so this is RF minus RP minus RF, this RF is given, which is the risk free interest rate, and if you take it on the left hand side, you have basically the excess return and you have the tangent. So, what you want to find out is that beta and where the value of Q is or M is, and whether the particular slope is greater or less, based on which you will find out whether the pricing of the stock has been done perfectly and what is the relationship between the efficient portfolio and the risk of that particular portfolio. Nothing to do with the market. So, you are trying to basically compare the efficient portfolio, if it is efficient, with the market and find out how good or bad it is. So, beta is a normalized version of the covariance of the asset with the market portfolio. Hence, we can say that the CAPM formula states that the expected excess return of an asset is directly proportional to its covariance with the market. It is this covariance that determines the expected excess return of rate of return. And what you are trying to do is that for any particular stock, you have standard deviation. So, what CAPM actually does is that converts the standard deviation, which is the best measure of risk for different type of assets, into only one corresponding symbol or use, which is basically the beta. So, beta or a particular stock or a particular portfolio or a particular efficient inefficient portfolio, whatever it is, gives us the overall scenario of what the risk of that particular asset is or the portfolio is with respect to the market. Now, we will consider the security market line. So, the CAPM can be expressed in a graphical form by regarding the formula as a linear relationship. Remember that is very important, and obviously you can extend it for the case when you have the non-linear relationship